In the months leading up to the presidential election in 2016, socially responsible investing was gaining popularity on Wall Street. In February, Larry Fink, CEO of the world's largest asset manager, $7 trillion BlackRock, wrote an open letter to global CEOs. Generating sustainable returns over time requires a sharper focus not only on governance, but also on environmental and social factors facing companies. BlackRock has been undertaking a multi-year effort to integrate ESG considerations into our investment processes, and we expect companies to have strategies to manage these issues. But when Donald Trump surprised the world with his presidential victory in November, proponents of environmental, social and governance (ESG) investing had reason to be worried. There was a lot of concern about the administration hurting flows by enacting barriers and regulations that work against our goals when investing around climate change and social justice, says Justina Lai, Chief Impact Officer at San Francisco-based Wetherby Asset Management. The perpetual urgency around these issues was only exacerbated by the pandemic and murder of George Floyd. With the Trump administration came 4 years of missed opportunities at additional progress that could have been made without an obstructionist government. Trump, on the other hand, was clear about his goal of reversing many of the Obama-era changes that favored the environment and corporate regulations. 4 years later, Trump's rhetoric and regulatory changes have been unable to derail the socially conscious investing locomotive. The reality is we've had more growth over the last 4 years than we did over the previous 12 years. After the 2016 election, people said that if the government isn't going to work on these issues, we're going to have to do it for ourselves, Peter Krull, founder, CEO and director of investments at Asheville, North Carolina-based Earth Equity Advisors says. If the last 4 years of growth were with headwinds, I'm really excited about seeing a tailwind. In a lot of ways, the concerns around the new administration ended up rallying municipal, state and local governments as well as the private sector, Lai adds. Other parts of the economy rose to the occasion. According to the latest biennial report from the United States Forum for Sustainable and Responsible Investment, USSIF, total US-domiciled assets under management employing ESG investing strategies increased 42% over the past 2 years, to $17 trillion in 2020, up from $12 trillion at the start of 2018. The figure represents 33% of all U.S. assets under professional management, meaning that 1 in 3 investing dollars is invested in this manner. While President-elect Biden begins to unravel some of the actions of his predecessor, he won't need to do much to encourage continued growth in ESG investing.